India's 93rd union budget is officially on the books. And like clockwork, we spent an hour and a half listening to thousands of words, complex economic jargon, and spending figures measured in the lakh crores. Finance Minister Nirmala Sitharaman laid out a massive roadmap, setting aggressive targets for national expenditure and making bold commitments about reducing the country's deficit over the next few years. But if you are a middle-class taxpayer, you are probably sitting at home asking a much simpler question. Is my tax bill going up or is it going down? We are going to cut through the hour and a half of political rhetoric. Let's look at the actual math to see how the government's macro-financial decisions are actively reshaping your personal wallet. To understand what the government is doing, you have to look at the union budget the same way you look at your own family's monthly ledger. This ledger compares a standard family budget with the national budget. Both entities have to estimate their incoming salary, or taxes, and decide exactly how to prioritize their spending, whether that's paying for groceries or building national highways. When your family spends more than it earns in a month, you have to take out a loan to cover the gap. When the government does this, they call that gap the fiscal deficit. And if you keep accumulating those loans over years, you develop a debt-to-income ratio. For the country, this is called the debt-to-GDP ratio, the ultimate measure of whether India is drowning in past credit card bills or keeping its head above water. Here is the core dilemma for you. The household of India is aggressively trying to pay down its massive debts. To do that, the government needs cash, and they usually find it by reaching into your pocket. This chart breaks down a single 100 rupee note to show exactly how the Indian government funds its operations today. Individual income taxes make up 21%. Corporate taxes bring in 18%. GST covers 15%. But look at the largest slice. A massive 24% of the government's cash flow comes entirely from borrowing and liabilities. The government is floating its daily operations on debt. This chart flips to show where that same 100 rupees goes once it is collected. 22% is immediately transferred to state governments. But the second highest expense is a strict 20% going directly to interest payments. Because of heavy borrowing sprees in the past, especially during the pandemic, a full 1/5 of all the money the government collects goes straight to servicing old debt, rather than building new schools or hospitals. This is why sweeping income tax cuts for the middle class are mathematically impossible right now. The government's debt servicing costs are paralyzing, and they desperately need your tax revenue to keep the lights on. So what is the government prioritizing with the cash it actually has left? They are executing a massive home renovation. They have allocated a historic 12.2 lakh crore rupees to capital expenditure. This money is earmarked for FARD infrastructure, like operationalizing 20 new national waterways and building 7 new high-speed rail corridors connecting major financial and tech hubs. The economic theory is straightforward. If the government builds better roads, railways, and ports, logistics costs drop. That makes local manufacturing cheaper, which sparks growth in small and medium enterprises, and ultimately creates jobs. The trade-off for you is time. The government is choosing long-term nation building over short-term cash handouts. You are paying high taxes today with the promise of widespread prosperity tomorrow.
While income tax slabs didn't change, there are specific, targeted policy shifts in this budget that will immediately alter your cash flow. The biggest change impacts the Liberalized Remittance Scheme, or LRS, specifically regarding the tax collected at source on foreign expenses. This flowchart illustrates what happens when you book a 20 lakh rupee overseas tour package. Previously, you were hit with a 20% TCS, draining 4 lakh rupees from your account up front. Under the new rule, that rate is slashed to 2%. Now you only need 40,000 rupees to cover the TCS. Keep in mind this is not a tax cut. You still owe your normal income tax at the end of the financial year. You could always claim the TCS as a refund later, but the government was locking up your capital for months in the meantime. They are no longer doing that. Whether you are paying for a foreign vacation, medical care, or sending a child to study abroad, this provides massive, immediate liquidity. Your money stays in your bank account longer. If the budget is so focused on fiscal discipline and infrastructure, why did the Nifty 50 instantly plunge 500 points on announcement day? Because the government cracked down on retail speculation. They raised the securities transaction tax on futures and options, pushing futures to 0.05% and options to 0.15%. They also changed how corporate buybacks are taxed. Instead of treating it as dividend income, it is now taxed as capital gains, placing an effective 22 to 30% tax burden on corporate promoters participating in the buyback. The government successfully closed tax loopholes and penalized high-risk market speculation, but retail investors paid the immediate price through a brutal, sudden hit to their portfolio valuations. Let's zoom out and grade the overall financial health of the household of India. This graph tracks two critical lines. The fiscal deficit, which hit a pandemic high of 9.2%, is now targeted to drop to a highly sustainable 4.3% by 2026. At the same time, the debt-to-GDP ratio is steadily declining toward 55.6%. A lower debt-to-GDP ratio proves to global lenders that India is managing its credit responsibly. This directly increases the probability that the country can borrow money at cheaper interest rates in the future. On a macroeconomic level, the plan is working. The foundation of the house is getting stronger, and the country is becoming far less reliant on emergency credit. This matrix plots out exactly who wins and who pays the bill for this fiscal discipline. Look at the winners. MSME owners gain new credit guarantees and growth funds. Parents of international students get immediate cash flow relief through the LRS changes. And investors positioned in long-term infrastructure stand to benefit from a 12 lakh crore tailwind. But look at the payers. Active F&O day traders will bleed from the STT hikes. Corporate promoters face higher taxes on buybacks. And the salaried middle class is carrying the exact same income tax burden as before, with zero new relief. The government is successfully fixing the roof and securing the foundation of the nation's finances. But to fund that construction, they require the residents to keep paying premium rent. You have to adjust your strategy to this reality. Utilize the new foreign exchange rules for better liquidity, rethink your high-frequency trading, and align your investments with the nation's infrastructure push. Because right now, middle-class tax cuts are not coming to save you.